Hi, everybody, and welcome back to yet another cracking installment of the Matt Brown Show. This is the Private Placement Perspectives series where we are shining a light on the world of venture capital and private placements. With me on the line from Ohio. By the way, Ohio looks amazing. I want to talk to you about that. But his name is Bill Baumel. He is the managing director of the Ohio Innovation Fund. Welcome to the show, Bill.
Thanks. Great to be here.
Fantastic. Well, Bill, I've been learning a lot about Ohio and what's been going on there from a startup ecosystem perspective. So it's really great to have you here. Bill, why don't you kick us off with the elevator pitch about the Ohio Innovation Fund and maybe paint a picture for us about how you got started in the world of venture capital and investing?
Yeah, I'll take the second piece first. I actually grew up in Ohio, went to Ohio State, then went to arch rival Michigan for graduate school. Went out to Silicon Valley for about 20 years and did venture out there, kind of learn the trade, and had some good success out there in terms of exits via M&A and IPO. And I got contacted by a few major foundations and institutions, including the Ohio State University, to come back to form a kind of classic venture fund, leading and primarily Series A investments, kind of first institutional round investments into tech and med tech companies. And so I came back around 7 years ago. What I found here is passionate entrepreneurs that really have firsthand experience with the problem they're trying to solve. They are very cash efficient. They have a lot of fortitude because of their passion. And what they really needed was, one is someone to encourage them to even think bigger and faster about what they want to do. And then someone to kind of help them show the road and how to avoid or overcome pitfalls along the way in scaling their companies. And so, the net of it is, when I came here, the annual celebration of the top growth company and the top exit was a company approaching $5 million in revenue, and a company sold for about $20 million in revenue. We now have companies in Ohio that we started 4 years ago that have achieved $25, $50, $100 million in revenue and grown from valuations typically under $10 million when we invested to valuations of 150, 250, 750, over $1 billion. And those valuations are all within the last year. So not kind of, before things, the market went down a little bit. Those are valuations being achieved currently based on their traction and their impact on the market. And so we're able to, because of the passionate entrepreneurs we work with, we're on track for a 5x, a fund here, or a little bit more than that. So it's been a great experience. I really like working with entrepreneurs that have a firsthand experience of and a passion about what they're trying to do.
Yeah, and I'm going to come back to that in a moment. So when you talk about private placements or investing into startups, what stages of startups do you invest in? Do you have industry preferences? Walk us through the kind of ideal profile of the kind of founder and or startup that you're looking to invest in.
Yeah. In Silicon Valley, you can say, hey, I want to invest in cybersecurity. I just want to do software as a service. I'm just going to do X, Y, or Z. In Ohio and the Midwest, you have to be a little more opportunistic, just because there's a broad range of high potential companies, but not necessarily 20 top-notch cybersecurity companies to choose from. There might be 5. And so we do have a broad range where we do both tech and med tech, so software as a service, cybersecurity, data science, mobility, biopharma, med tech, kind of across the board. And that really is leveraging. One of the things that has happened is I historically was about 80% tech, 20% med tech as far as investing in Silicon Valley. Here it's about 50-50, just because there's a number of institutions like Ohio State, Nationwide Children's, Cincinnati Children's, Cleveland Clinic that just have a lot of expertise and a lot of great, startups being spun out. We are typically at the Series A level. And so that's about 80% of what we do, which is the first institutional round. There's been some friends and family or seed money raised, but we do, once a year, invest in a seed company. That takes a lot more time, but when we see something with a really, really strong entrepreneur and an opportunity with a lot of promise, we will get involved at seed stage level. And then we keep supporting the company in Series B and onward. Obviously, once the company in one case went from a 9-ish million valuation to Series A up to now north of $1 billion valuation, $1 million or $2 doesn't buy the same ownership at that level as previous. So we do kind of taper off over time in certain cases.
And do they need to be revenue generating? And how often do you look at, say, pre-revenue opportunities?
Yeah, on the biopharma side, everything is pre-revenue. We're sometimes preclinical, sometimes phase one. On the tech side, eFuse is one of our companies in the esports and gaming area, as far as a software platform, partnering with the Epics and ESPNs with the games, and they actually recently had with Epic Games had a Fortnite competition between Ohio State and Michigan around the big game back in November. That started with one person, actually a former intern of Ohio Innovation Fund. And he has built up that company now. It's approaching 100 people. It launched in December 2019. It's approaching $30 million in revenue. So that was kind of just one person with an idea and a piece of paper. That's the earliest we get involved. A number of our companies, like Aware, which is a cybersecurity company, or Amuta, which is a data science company, they may have a few $100,000 to a couple million revenue, and then we kind of go from there.
Perfect. So I've got a off-center quick question for you. What do you wish startups knew about your investment firm that they currently lack?
Do they currently lack in terms of help they need, or?
Well, just something about your firm that you wish they knew, but the world doesn't know about.
Okay. That's very interesting question. That actually, we now, when we talk to people, we don't consider our companies portfolio companies. We have a lot of respect for the founders, their vision, their passion, their blood, sweat, and tears. So we really try and partner with the founders. We aren't co-founders, but we work with the founders to help achieve their vision and help them all along the way. So that level of co-passion, co-working together, collaboration, and the extent that we care and add value to the companies to make them successful is really unique to what we do, particularly here in Ohio. In Silicon Valley, there are repeat entrepreneurs, and even if you're not a repeat entrepreneur, you had a parent or sibling or classmate or friend or lots of people that's been startups. For a lot of people here, this is their first startup. And so that level of being there with them and going through this process of scaling the startup with them is very important, which is why our CEOs, I think, are our best advertisement, so to speak, and really now the primary source of our high quality deal flow, where that is our differentiator. If anyone asks about why OIF, instead, I may speak for a little bit, but I really want to get to, okay, can I get you in touch with our CEOs? Because they will sell you on why OIF, how positive and collaborative and impactful we have been, and how much we just really care. I mean, we want to see their vision come to reality and fulfill its potential. And that's really a co-passion we have with them. So they're not just some number. They say, okay, well, this thing can make, we invested $2 million, it can be worth 10 or 20. They're not just numbers on a spreadsheet or just portfolio company A, B, C, and D. They really are, unique companies with us. And that makes it a lot more fun for myself and the team as well, because we enjoy going out there and working with our companies and helping to scale them up.
There's a lot of talk about ecosystem, and I'm curious because when I first came across, like, oh, a higher innovation fund, that's really interesting. Like, I've never been exposed to the ecosystem there. How would you characterize it at the moment? Is it growing? Is it kind of staying the same? Do you see, more issuers coming to the table, more startups coming to investment firms such as yourself to raise capital? What's going on in Ohio's ecosystem at the moment?
Yeah. I would say that, from when I first came here in 2016, it was in its infancy, and it has grown dramatically. The first thing was strategic partners realized wanting to become involved in the companies because they saw the impact these companies were having on a global scale. We have a health med tech company where Sanofi, one of the leading pharma companies, led actually after doing the Series A, they led the Series B. We have another company that has partners such as Microsoft and Meta and Slack, which is now part of Salesforce. We've had Snowflake and ServiceNow and others invest in these companies. So the first step in all this was there initially was some external interest, but the strategic partners almost came first because they saw what we're doing in the marketplace with our offerings. And since that's happening, we are getting more and more interest, from the outside. With a point now, within this week alone, I've gotten 3 phone calls from major venture PE firms on the coast about a couple of our companies. And that's not an unusual week anymore, where it used to be always us reaching out and what have you. So that it seems to have shifted in terms of there's a lot more outside, institutional interest in what's going on here by orders of magnitude than there was before. But it's interesting that the strategic partners moved first. It was the Sanofis and the Genentechs and the Metas and the Microsofts that recognized the potential first, and then the venture dollars, followed.
That's really interesting and fantastic to hear. I mean, one of the things that kept coming up in South Africa was this role of the ecosystem. Obviously, we don't have the kind of ecosystem like I would say that even Ohio has, but it's a consistent thing, isn't it? Because even when I speak to founders, I asked them, like, if you're based in Silicon Valley, like, what role does that play? And one of the key things that has come up on this show is that, if you're based in Silicon Valley and you have this really crazy idea, if you go to a venture capital firm and you go, I've got this really crazy idea, they're more likely to believe you than if you were based in Texas. You know what I'm saying? And then the other weird observation is that in Texas, there's a complete over index towards healthcare, medtech, biopharma startups. So every state and its ecosystem plays a role. And so it's great to see and to hear what's going on in Ohio.
Yeah. It'll be, and that is, even the entrepreneurs, how they pitch is very different. In Silicon Valley, you can listen to a 30-slide presentation with everything in detail, including partners, customers, and product, and find out at the end, that's kind of target customers, target partners, and what we intend to build. Here in Ohio, it almost started off the exact opposite. Like, well, here's what we have, but we're going to have. They don't want to talk about. That's 3 months from now that we'll have that, so we can't even talk about it. I mean, just that mindset change, and so that's been happening, and thinking bigger, broader, and moving faster has really helped accelerate a number of the companies. I mean, I look at eFuse with a former intern launched in December 2019. I mean, 2 and 3 years grow from 1 person to close to 100 people, and grow to quite a bit of revenue now is really. Is really incredible, and a number of companies have done that. So it's been a sea change mentality wise.
Yeah, absolutely. So I'm curious to find out from you, how do you find startups to invest in? Like, what are the key factors that you look for when deciding to make an investment or not?
Yeah. As far as just finding in the first place, when I first came here, it was a lot of just knocking on doors and networking, all that. We have built up our brand in terms of, particularly with the CEOs and founders, so they refer us and serve as strong references. So that has created a lot of strong, high quality inbound deal flow. And then when we look at that, we're looking for one advantage of being in Ohio versus Silicon Valley is that when someone goes out with a good idea, in Silicon Valley, there might be 6 or 9 term sheets within days or weeks. Here, it takes a little bit longer. So it allows us to get to know the entrepreneur a little bit better. So we try and look at, okay, what is the reason for doing this? What is their passion behind this? And then obviously you have to look at the market. Is it a company that can scale? We're typically looking for companies that can scale at least $100 million in revenue and in a reasonable period of time, and obviously hopefully more. But so we're looking at that in terms of the market being attractive. We're looking at, and those are common things all over. Looking at the product, how unique it is. We look a lot at the acquisition. Who's going to acquire this for how much and why, and how much leverage are we going to have? Because sometimes in acquisitions, people will say, "Well, I could just do that you save us some time and money, but we could do that ourselves internally." I want things with enough intellectual property and or market, presence that you can almost laugh at that and say, "No, let's just stop talking about that. Let's talk about a real strategic." Type acquisition. But the one thing that's kind of unique that we spend a lot of time with is really getting to know the founder personally, both on passion and kind of thought process. Are they open to feedback? We'll be talking about different things, how they react to suggestions, how they react to things, because we want them to be open-minded, and be out there to search for reasons why things aren't going faster. Even if they're going fine, why aren't they going faster? So when entrepreneurs are open-minded in terms of, I want to find out what the problems are. I want to find out what, if anything, is holding us back in terms of either the sales force or additions to the product or our messaging or our target marketing or whatever it is, because we want to just find out how can we scale more quickly, and also open entrepreneurs that are willing to say, I need to build a team around myself with complementary skill sets that are probably better at doing what they do than even I am as good as doing what I'm doing. So not only they do complementary things, but I want the next level even better than myself in those complementary areas. And it's not intimidated by that. So that relationship with the entrepreneurs and founder is really important, because as I mentioned earlier, that's such a key part of what we do is we share their vision, we share their passion, and work with them to scale the companies. If there's not a good, open, transparent relationship where we're looking to add high quality people and find out issues and find out problems to really scale it up, it's not going to work.
Do you back the jockey or do you back the horse? Because there's always that I was speaking to Steve Blank about this, and he said, "You know what, Matt, in Silicon Valley, we've got a term for an entrepreneur that's failed. It's called experienced." Yeah. But it's a great point, isn't it? Because I've founded 14 startups over the last 25 years, sold a couple, but pretty much all the others failed. But if I hadn't had that experience, you know what I mean? Do you back Matt, who's failed, that amount of times, or do you back a first-time founder with a great idea?
Yeah, at this point in time in the ecosystem, I don't have that choice. If you look at all of our companies, we have one called Enable Injections. That's the one where it's in Cincinnati that Sanofi led the Series B. Mike Hooven's the founder there. He had done a company called AtriCure, which is now about a $2 billion market cap in the med tech area around atrial fibrillation and such. Other than Mike, I mean, our entrepreneurs, for example, I'll give you an example at Compliant up in Cleveland, which is an e-regulatory company. Our founder, Rick, was a PhD, MD at Case, doing clinical studies. Just said, I'm tired of these big binders. I'm tired of everything being on paper and and if the FDA comes to look at something, trying to find it, can't we do this all in software and store it in a HIPAA compliant cloud? And so that's what we're typically finding. Jeff Schuman, the founder of Aware, which is cybersecurity around collaboration products like Slack, was trying to roll out Microsoft Yammer at Nationwide. And they're saying, well, what about security? What about compliance? All this. He said, okay, I'm going to go form a company to deal with that. So we're typically dealing with first-time, passionate entrepreneurs who really, really understand the problem because they've had firsthand experience. A little bit different than in Silicon Valley, where someone might be a great data scientist and say, okay, what are the different areas I could go into and what is the most promising and lucrative? Here, I mean, people find a problem and they want to form a company around the problem they solve. Then we really need to figure out, okay, is that a big enough problem to create, is it going to be a market and big enough for us to, to build a reasonably sized company here and exit most, every once in a while IPO, but most likely to strategic acquire.
Awesome. We'll be back in a moment. The Matt Brown Show is presented by Carafin, an investment bank that offers and supports direct private investments in U.S. operating companies. Over the past 20 years, investors have placed over $1.2 billion of private debt and equity in more than 100 companies through Carafin and its affiliates. Carafin leverages technology to empower its community of investors to deploy their capital far more efficiently than ever before and connects their community of engaged investors with worthy companies. Invest portions of your portfolio in direct private investments today. Visit carafin.com/Matt Brown Show for more. And we're back. Gotta love sponsors. It's like this dramatic pause with the guest on the end of the line. So I'm curious to ask you this one, Bill. You see a lot of pitch decks. You get pitched a lot. What would you say, in your experience, Bill, is the most common mistake that you observe startups making during their pitch to investment firms like yours?
Yeah. Particularly on the tech side, not having looked at market validation, and either having some customers or having talked to some customers, having talked to some potential partners. We see that. We see that quite a bit. And sometimes you need to get them to open up about the passion, why they want to do this. It's almost too summary level. Kind of, here's what I'm attacking. Here's what I think the market size is, versus like really, being more passionate about and explaining, the problem they have. And here, unfortunately, too, and it's more an Ohio thing, is that sometimes the business models just don't make sense as far as the projections they show. It doesn't make sense. They're just kind of high level and not really based on the reality of kind of who you'd hire when to develop what and sell what and what's realistic in terms of margins, and because that's important in terms of how the company can scale revenue wise, what the margin structure looks like, and also how much cash is going to be needed. Sometimes that we do ask, like, okay, well, we're going to raise a Series A and then raise a Series B. Well, how much cash do we need? Kind of this, and they don't know. That's just, I think, more of a on the one hand, not come across passion wise, is more of a Midwestern humble thing, and then on the kind of the the modeling of the company is more of just lack of experience here.
Yeah, very good. So obviously, as a venture capital firm, you have a portfolio, and I was looking at. I've got your website up for everybody. So if you're catching this on the audio version, you guys kind of know what you're doing, right? You 5 unicorns, 15 major exits, etc. How do you balance risk here in the sense of the strategies around venture capital management? So what strategies do you employ for argument's sake to balance the pursuit of these high returns, these unicorns, these exits, with risk management in these kinds of investments?
That's one of the nice things about Ohio, actually, in the Midwest, is that because you're typically not doing all one type of investment or in one sector, there is some balance. So you may have 1 or 2 cell and gene therapy companies, 1 or 2 biopharma companies, 1 or 2 med tech, 1 or 2 cyber, 1 or 2 software as a service, 1 or 2 data science. Each of the tech companies may be attacking similar different end markets in terms of financial services providers or healthcare companies, pharma companies. And so at the end of the day, just almost by the way Ohio and the Midwest is, as far as a very diverse set of high growth industries here and startups to invest in, you come across with a reasonably diversified portfolio. So if that, I know the cell and gene therapy market has not been as hot now as it was maybe a couple of years ago, where things were going nuts. And so by nature, you only have 1 or 2 of those. And now, data science, AI, well, you got a few of those as well. So just almost by nature, Ohio, the Midwest, kind of forces you to create a diversified portfolio across industries, which is helpful to have all your eggs in the same basket of biopharma or everything in a certain area.
If you do that, you better have a very patient set of LPs.
Yeah. Yeah.
Very interesting. So there's a lot of talk about different types of capital structures when it comes to doing these sorts of investments, safe notes, convertible notes, etc. Do you have a preferred, or is there a most common capital structure or method by which you make these investments into high growth startups?
That is, I'm not laughing because of OIF's position on this. I'm laughing because of what we came into. On the West Coast, most things are non-participating preferred. There's no cumulative dividends. There's no redemption rights. And then more on the East Coast, you have more participating preferences than on the West Coast. You have more times you'll see cumulative dividends. You'll have more times where you'll see redemption rights. You'll see more of that. Ohio has really been a hodgepodge of everything, including creating, instead of like Delaware Corps, you're creating Ohio LLCs, which with its own unique set of rules I don't know if people really fully understand. So we have tried to become much more standardized in terms of doing the safe notes. At the seed level, let's do a safe note with a cap, and leave it at that. And then there'll be a pricing in the Series A. And so when we get involved at the seed level, that tends to make it very clean as things go by. But we have been involved with some companies at the Series A level where they might only be $700,000 in revenue. They've had 4 seed rounds, each seed series 1, 2, 3, and 4, each with different terms that are sometimes incongruous with each other. So there's some cleanup there. So we like to keep it simple and as standard as possible. Utilizing NVCA, kind of standard term sheets. So we just try and it's hard enough building a company. When you're going up against the big companies that have all the money, all the customers, all the developers, that and the other, much less like having some sort of crazy financial structure that causes some sort of incentives that you don't even understand. So we try and keep it simple.
Fair enough. And I'm also curious, do you feel like startup founders understand? So when they talk to you and you go, yeah, no, it's going to be a convertible note, cumulative deferred shares, like the languaging around the deal, do they understand? And what could a startup founder do to have a more constructive idea around how they want to cap or structure their capital investment from a VC, for example?
Yeah, I think here there's been a somewhat of a lack of understanding overall, not from all, but from some, just depending on the amount of experience. We try and hopefully as more and more as our ecosystem grows, there's more and more people getting involved with NVCA and other things where they learn about kind of standard term sheets and terms. And I know that Wilson Sonsini puts out each month or each quarter, like okay, that's kind of to some of our a lot of our companies, we just have to explain like, okay, here's how participating versus non-participating preferred works. And then another investor will tell them, oh, everyone does it this way. So we literally have to pull out a Wilson Sonsini thing that says, okay, in this quarter, 90% of deals that were Series A were non-participating preferred. So that's not how everything works. And so for us right now, it's us trying to help sort through and educate. But hopefully after time, and that's also, with the success we've had so far, the good news is that typically entrepreneurs are even more successful the second time around. They've learned from their mistakes. They pick as good or a better market. They are more insightful about it because usually they know who tried to acquire them and what they're going to want to acquire next. And so if I look over the next decade, as hard as it's been to get to where we're at now, but as much success as we had, I expect it to be even an order of magnitude bigger success, just because we'll be working with entrepreneurs from our companies that have exited successfully that kind of have learned the ropes and know these things and will be all the better for it the next time around.
Bill, You speak about exit strategies, and that's where I want to take this conversation now. What is your approach in terms of evaluating whether a startup has a high potential for an exit? That's the first thing. And then secondly, how do you prioritize exits? In other words, are there particular factors that you would consider when deciding to sell an investment?
Yeah, yeah. I mean, we're looking at, a lot of times it'll be natural, like who would want to be a strategic partner, and how would we complement what they do, and how would we work together, and how would we make what they're doing better and us doing better, and how could we potentially dominate a market together. And we have to do that analysis, and oftentimes those people become strategic investors, strategic partners. So it's kind of, each one's an individual case based on the company, but you kind of have to look at, okay, who would you really matter to in terms of differentiating their offering, and how important what you bring would be to them. In terms of the exit piece, I mean, what we all say is just keep building a great company, and these things come along, and they do. And they always, a lot of times, they come from a partner, or they come out of the blue from someone that, in hindsight makes sense. And what we look at is, what percent of the value has been captured. So we might have an acquisition offer of two acquisition offers, one at $100 million in cash, and one at $750 million in cash. This is actually real examples. One, we're saying, hey, in the one case at the lower offer, there was more competition coming to the market. And the people that were actually offering to us, potentially they were partners that could become competitors. The market was getting more crowded. Our differentiation was becoming less and less. We're getting boxed in. Okay, $100 million. I mean, we look out a couple of years, and if we're successful, maybe get up to 150 or 200. But a decent amount of the potential value has been put on the table, and there's substantial risk. In the other case, even though it's 7.5 times that amount, we're like, hey, any sort of comp will show you this is a $5 billion IPO. And therefore, we're leaving 80% of the money plus the money on the table. Now, there's obviously execution risk, but I mean, if you still have 8% or more of the value yet to be created over the next 3 to 4 years, and you feel really good about the long-term position of the company from a market and product and customer perspective, then we tend to go for it. We are more, I mean, we do have a strong IRR, 30% range, but we're more focused on the X. Venture is a unique asset class where you put in $1 to try and get, on a deal, $10, $20 back or more on the successful ones, and on a fund, $5 back. And you can't do that, typically investing in, the S&P 500 or other areas. And so what we don't want to do is, if we're getting the majority of the value, and there's a decent amount of risk going forward, and it doesn't seem like our position is going to get better from here, let's take the deal. If we're getting less than the majority of the value, and we got a really strong position that we think we'll maintain, let's go for it.
And do you have a time horizon when let's say Matt Brown comes along and goes, hey, I've got this incredible idea, and you go, oh my God, Matt's failed so many times, and I like this guy, I like what he's about. And in your mind, if you're looking for a 10, 20x return, is there a time horizon that you're looking at? Typically, is it 3 to 5 years? Do you not care? Is it more just about the IRR?
Yeah, we're typically, to build up a company the level we're talking about, is 5 to 7 years. Because you're trying to scale from very, less than $1 million or $1 million in revenue to 10 to 20 to 50 to 100. And each company is different. Along the way, if we have, let's say 10 tech companies, there might be 1 or 2 that fall out just because they fall out. And then there'll be 1 or 2 along the way that are doing pretty well. And $100, $200, $3 million offer is enough for the value that we think we can create, given the risks ahead, and maybe it's a noisy market or certain things are going on. And then it's really your big winners that typically take some time, because they are able to scale up to $100 million in revenue, but you can't scale $100 million in revenue typically in a couple of years. Some companies have, but that's more rare. So for your big winners, they like a good wine. Sometimes they need to, kind of air out over and just ferment and kind of,
Oh, that's funny.
And that's a balance with the limited partners too, because they obviously, want distributions, sooner rather than later. That's exciting to them to, as much as they love supporting and are supportive, they love the wires of cash going that way too. So it's a little bit of a balance, and we've been lucky enough to have a few along the way, like Able and the HR tech company, and Sterling Ultracold, which is a bio med tech company, that were sold out, and that Sterling, I think, was a few $100 million and was able to get a nice amount of cash back, and some of the other ones like Aware and Able and Muta and eFuse are growing to those bigger levels where they are worth now hundreds of millions or $1 billion, but they still have a lot of growth and upside ahead of them as well. And we allow those other ones to ferment a little bit more.
Awesome stuff. Guys, we're going to be back in a minute. Raising money for your startup? Well, why don't you close your next funding round fast? Get investor-focused media and FaceTime with relevant investors in days. Visit showworksmedia.com for more. That's showworks with an X, media.com. And we're back. Bill, I have a fun question for you. I don't know why this one works, but it's very revealing to the guests. So I hope you're ready. So what keeps you up at night when it comes to the world of venture capital?
Oh, geez. What's keeping me up right now? I mean, we're in a good situation where a number of the companies have raised rounds in the last year that provide them with, a couple years up to 4 years of operating capital through exit, through IPO, what have you. This market, the overall economic and market environment, here in the States at least, driven by the Fed raising rates to try and cool inflation, it obviously has hit mortgages and other things like that, industry and all that. It has people just kind of generally worried. I'm hoping the inflation data seems to be becoming better in terms of tampering down a little bit, and hopefully they won't have to do too much more, so don't create a huge recession. We do look at our companies, at the board level now and say, okay, we're much more disciplined and proactive on and making sure our payback ROI analysis, particularly on the tech side, are very solid. So when they're looking at, we were thinking about doing these 10 projects, we're only going to do 5 now, that we make sure that ours is one of those 5 that are, the most critical to do in the upcoming year for a JP Morgan or whoever our client is. But really my sleeplessness is really just with, right now we're at 15 active companies, is just day-to-day stuff that happens, a partnership discussion here, a replacement of a CRO there, it's just a constant thing where I have to just live a life where, given with 15 startups, in the Ohio, Midwest, there's going to be something's going to hit the fan somewhere in one of the 15 every week. And that's what I deal with that on that week. And I lose sleep over that. Then next week I'm losing sleep over something else. And I one wish, if you ask me another question, one wish I would have is that, I get a lot more phone calls and invitations to meet just to tell me good news.
You get those?
We did this. But no, but I'm very, the communication and relationship with our CEOs and founders is incredible. And they've made, just enormous progress. And you're talking about differentiating earlier. I think that's really something that takes time to build up, is that two aspects. That one is the trust, that they can tell you everything. It's not going to come back and be played in their face. That's so important, that they can trust you and tell you, like, almost like, okay, here's my worries, here's my fears, here's my issues. And they say, I can tell you that without any, I told you so's, or somehow coming back to bite them. And then the other thing is, obviously, when you give them advice, and it works, and they're like, oh wow, this was solid, then they come back to you more and more. And that just, I've had to learn that just, given in the Midwest here, it's going to be every day there's going to be something that comes up, and I just have to kind of live with that reality and sleep best I can.
Yeah, well, we all have these. It's just one. Like, there's always problems today, but the same problems today with the same problems tomorrow, typically. Or maybe they get bigger. I'm not so sure. But how do you see the role of venture capital evolving over the next 5 to 10 years? If you imagine, as an example, crowdfunding wasn't around, 10 years ago to the extent that it is now. So, on the totem pole of where you get your money from as a startup founder, how do you see the role of venture capital evolving in the future?
Yeah. I mean, right now, at least in our area, if anything, there's not enough cash. So I don't think that there's a huge, we need more venture rather than less venture in the area. As far as syndicates, both for financial purposes and then just for networking and working with the companies, is very important. So I'm hopeful that we will start to build up the Ohio area similar to, someday a Boston or Silicon Valley, but at least for now in Austin or Seattle or something like that, where there's a handful or a couple handfuls of high quality venture firms that syndicate and work on companies together to help build them out. I think that's the next step over the next 5 years. I'm hoping that a lot of our entrepreneurs, perhaps either start new companies or have learned a lot and therefore become venture capitalists themselves, and then kind of pay it forward. Because we're at the early stage. I mean, we've in Ohio, our the biggest exit was something called Cover My Meds, which sold for $1.25 billion to McKesson. And we're just now having the next wave of $1 billion plus IPOs and multi-$100 million acquisitions and within this particular geography. So that hopefully will have the same multiplicative effect that started Silicon Valley with Fairchild Semiconductor, where out of there Intel and Kleiner Perkins and all those Apple come out of. And that's my hope in the next 5-10 years. For the where we're at.
Perfect. So I'm going to have a quick bit of fun with you. So if I could give you the keys to the Matt Brown Show time machine, and you could go back to yourself on day one when you were like, I'm going to get into the venture capital space and the investing space, but you hadn't had all the experience. What advice would you give yourself about investing in startups?
Yeah. I think early on, I became more enamored with the idea and kind of perhaps didn't get to know the founders and the team well enough. So that yielded either suboptimal company performance because of that, or not as productive and of a partnership in terms of working together to build things up. So I was, like you mentioned that question, is it the jockey or the horse? I was, sitting there, enamored how fast the horse could run, or how, what a great code or whatever it is, the horse had, and spent some time getting to the jockey, but not much. So that has changed over time. Whereas I said here now, really get to know the entrepreneurs and how they think and how open they are. Because if they're not open to me, they're not going to be open to the market and the market's feedback. Because we don't need an entrepreneur out there trying to bring something to market where they come back and say, "Oh my gosh, the customers and partners just don't get it." Okay, that's good to know, but that doesn't help us because we're not going to sell anything or partner with anybody. And we're going to have business, and we're not going to have a next round. So that's something I had to learn over time, that it isn't just and not to chase sometimes science projects that are really cool, looking for how to apply those in a realistic way.
Right. So let's wrap this up, Bill. What's for startup founders out there who, because everyone's in some kind of capital fundraising cycle at some point in time, like that's just how it is. what's one, and there's a lot of advice you've given to date, but if you were to pick something to hang your hat on to a founder who's looking to raise, what would one piece of advice be from your side to that founder around raising money from a venture capital firm?
Yeah, I would say just a concise, impactful statement of what you do and why you matter. And I say that for a couple of reasons. Number one is every company that I've had go public or been acquired at large numbers has been able to do that. And that's whether it's something simple for everyone to understand, like, in diabetes management, would you rather prick your finger all the time or have a continuous glucose monitor that gives you a reading every 5 minutes to know if you're too high or too low and you can manage your diabetes better? Most people say, I don't want to prick my finger. I'd rather do that. Down to a very technical thing like a company called Infinera, which is like, okay, we can consolidate hundreds of JDS uniphase components in the chip the size of your fingernail. No one may understand how that works, but you can understand the cost savings, the space savings, the power. If you can concisely and impactfully get that across, that's so powerful with VCs, with customers, with partners, with employees you're trying to recruit. You're all around that mission. It also addresses the fact that VCs, like I said, you ask me, well, what's keeping me up every night? It's a different thing all the time. We have typical VCs are on 6 or 9 boards. And are looking at a handful of companies. There's so much going on. If you can't be concise and impactful, 5 minutes in, you may think they're looking at you and they're really like thinking about this or that or the other thing. So if you just get that across, why it matters, and just get that across right in the beginning, and get their attention, that typically bodes well. And if you can't, there's usually an issue because you can't do that. So there's something needs to be worked on.
Yeah, you don't know your business well enough.
Yeah. Yep.
Right.
Yep.
Bill, thank you so much for being here. It's been a real privilege having you on the Matt Brown Show. You're doing amazing things. Congratulations on all your success so far. And it's been a real privilege having you here.
It's been great being here. So thank you so much.
Anytime. Thanks, Bill. Thanks, everyone.
Bye.